In the meantime, some shareholders more equal than others. The News Corp's bid for Dow Jones reminds us that for many companies, there are two classes of shareholders: those with the voting power and then the lowly ordinary shareholders like the rest of us. So what's in it for this second class of stock citizens? Often a bit of a discount in share price. Does that mean some opportunity? Well, here to explain, Scott Smart, professor at Indiana University. Professor Smart, great to have you with us.
Thank you, Aaron. Good to be with you.
All right, so let's get straight to this. You did a study of, we've got, what, about 10% of all the companies in the U.S. actually still have these slightly antiquated share structures, right?
That's correct.
And then you looked at all the IPOs that come to market that have this structure, and you looked at the performance.
That's right, Aaron. We looked at IPO firms that came public in the 1990s, and roughly 10% of those were dual-class firms, and the rest were ordinary one-vote per share firms. And we really asked several questions. The first question we wanted to know was whether investors attached any kind of a discount to the dual-class equity, since they didn't have exactly the same voting rights that a traditional single-class stock would have. And in fact, that's what we find. If you look at a dual-class firm and compare it to a similar single-class firm, same size and same industry and that sort of thing, the dual-class firms are worth about 15% less per share on average.
But you said over, say, a 5-year time frame, that difference goes away, right?
The difference in value doesn't go away, but there's not much difference in performance, per se. The analogy that I would give you is if you're looking in the same neighborhood for a house and you have a 4-bedroom house and a 3-bedroom house, the 3-bedroom house is generally going to sell for less because it has less to offer. But that doesn't mean that as an investment it's going to underperform or outperform the 4-bedroom house. And in the same way, when we look at stock returns, the dual-class firms and the single-class firms perform about the same over time. They perform about the same, so I guess it doesn't really matter, you know, unless something goes wrong, like at Dow Jones, where all of a sudden a bid is on the table with a huge premium, and this family with all the votes says, oh, it's not good enough for us for some who knows what reason. The rest of the shareholders are crying. That's exactly right, Aaron. It turns out that where single-class firms and dual-class firms seem to differ a great deal is in the question of control. Who runs the company and under what circumstances can that control be changed? For example, at a single-class firm, what you typically see is that if a firm is not doing very well, the top management team has a pretty good likelihood of turning over, and new managers will be brought in to replace them. But in a dual-class firm, we really don't see that. Whether the firm is performing badly or not, the management team is pretty well entrenched, and it's tough for outside investors to move them out if they're not doing well. Professor Smart, you couldn't see, but as you were speaking there, a chart of Google came up, and I must ask you, I mean, you talk about, you know, these dual-class shares sometimes having a discount to everybody else. You looked at IPOs. Well, Google was an IPO. It's two classes, and goodness gracious, it has beaten pretty much every stock out there. One of the best performing IPOs of all time. Is Google just an exception to the rule? Well, if you look at dual-class and single-class firms as a group, you can always find firms that are at the top of that distribution. So right now, Google is the stock with a hot track record. It's having a very similar post-IPO experience to the one Microsoft had 20 years ago. Microsoft, of course, is a technology firm like Google is, but it's a single-class structure. And so you certainly can find examples of excellent performance in both groups. You can find examples of poor performance in both groups, but on average, there's really not a great deal of difference in terms of how the stocks perform. All right. Thank you very much, Professor Smart. Scott Smart joining us there. And a break for us. And on the other side of it, Treasury Secretary Hank Paulson has a plan to help U.S.-Chinese relations, and it's a little old-fashioned matchmaking, as we're calling it. Hampton Pearson is on that story for us. Ham.
Hey, Aaron, how about a blind date on Capitol Hill with lawmakers and Chinese officials in a few weeks? That's what the Treasury Secretary has in mind. Wonder if they'll order takeout. The trade menu when Street Signs continues.
You're watching Street Signs on CNBC, America's business channel.